Franchising is fantastic for people that have never done the thing that they're buying a franchise for, and they want to follow exactly the formula and process of the franchisor. You don't want to go to McDonald's and have a burger that tastes different than the other McDonald's. Formula has to stay the same, the process has to stay exactly the same so that it's consistent across the entire system.
Welcome to P&L, Priorities and Lifestyle, with your host, Rob Schultz. Rob is the founder and president of Schultz Wealth. All opinions expressed by Rob and his guests are solely their own opinions and do not reflect the opinion of Schultz Wealth Limited. This podcast is for informational purposes only and should not be relied upon for investment decisions. Please refer to our website for more information.
Welcome everybody to P&L, Priorities and Lifestyle. I'm your host, Rob Schultz. And today we have entrepreneur extraordinaire, Mr. Jeremy Brandt. Jeremy, welcome today.
Great to be here. Thank you.
We really appreciate you being on. I have seen WeBuyHouses.com for as long as I think I've been in the Metroplex, probably 30 years, something like that. Close to it, maybe.
It's been around for a while.
It's been around for a long time. You are the founder of WeBuyHouses.com, the most recognized national platform that connects home sellers with residential real estate investors. You're also the founder or investor in dozens of different companies, primarily at the intersection of real estate and technology. Background in technology, and then we'll get into the story a little bit later about how you ended up in the residential real estate market. Your companies have helped millions of home sellers find a solution to selling their house fast and facilitated billions of dollars in transactions. You're a lifelong entrepreneur, and you spend much of your time supporting early stage founders and mentoring accelerator programs. We really appreciate you being on the show today to do just that. So we can talk at a real level about kind of what it takes to be able to develop these different companies and be successful over a very long period of time. So thanks for being on, Jeremy.
Yeah, I appreciate it. And we talked a little bit earlier, and I've had a lot of mentors in my life, people that have given back to me, and especially early in business, anytime you can cut years or hundreds of thousands or millions of dollars out of the process of starting a business. I made so many mistakes early on, and then learned a lot of lessons the tough way. But a couple of them, mentors stopped me from making mistakes, and so I love to share that with other people.
Yeah, that's excellent, Jeremy. So, how did you get into the business of WeBuyHouses.com? What's the story behind that?
Well, when I was in my late teens, I was a computer guy. Got into technology at kind of the right time in the late 90s, and was building kind of the plumbing of the internet, routers and switches and servers. I was a network engineer at the time, and amazing time to be kind of in that field. Felt really successful and was really progressing quickly. And then the dot-com bubble burst.
Right.
I lost my millions of dollars of stock options that never materialized, my great salary. I got laid off, and found myself as a 21-year-old kid, very ambitious, but no college degree, some work experience, but nobody was hiring technologists at that time. Right, everybody had just been laid off, and so I started flipping houses in the Dallas area, and really enjoyed it, and was pretty successful at it. And pretty quickly just combined my kind of love of real estate and housing with my love of technology. Started doing online marketing. Really, I think we were one of the first people in the country to do online marketing specifically for distressed home sellers, people that want to sell to an investor. And started getting people from all over the country contact us that wanted to sell their house. I was buying houses here in Dallas, so I wasn't going to fly to Miami to look at a house. And we would call up real estate investors in Miami or Atlanta or Chicago or LA and say, we've got people that want to sell their house to an investor. Will you give us money if we connect you? And everybody said yes, because the housing market was taking off. And that very quickly eclipsed the home flipping business. And I shut that down to focus purely on the technology side of the real estate investing, providing leads to real estate investors. I started in 2002, and really enjoyed it, continued to grow it. And from the profits of that company, was able to buy WeBuyHouses.com maybe about 14 years ago or so. Some real estate brokers in Florida owned it, and we were able to acquire that, kind of change the business model around. People were very familiar with WeBuyHouses.com, but I felt like it was a really underutilized asset. And so I was able to buy that, shut down everything that they had built, and recreate it as kind of a brand license where people operated under our brand all over the country, locally owned and operated offices where we provide technology and back office support to them. So we've got kind of the lead generation business that we started with, Fast Home Offer, and then about 15 years ago, WeBuyHouses.com, that I think is one of the most well-known brands now for people that flip houses, and has a lot of awareness from consumers that if I want to sell my house quickly to an investor, WeBuyHouses.com is the way to go.
Yeah, no question. Incredible brand awareness.
Thank you.
So one of the first decisions it sounds like that you made after you were flipping houses and figuring out how to basically generate leads through this, we're talking about early 2000s. Very few people really knew how to do that at that point. And you made a decision that you weren't going to go to Atlanta or go to these different markets to flip the houses off the leads that you were generated, but rather that you were going to sell these leads. That sounds like that was a really important decision at that time. Were you tempted, or did you try to kind of go outside of market when you were there and realize that wasn't something that you wanted to do? I'm just curious.
Yeah, I think I did try to do that. I flipped some houses in Austin and Houston and San Antonio, so in Texas.
Just Texas, okay.
I flipped a couple of houses and realized that just logistically, it's quite difficult, especially back then. It's a little bit easier now to do that remotely. And so I was successful at it, but I really felt like it didn't scale. And one of the kind of core things about how I operate business is I'm always looking for the efficiency. What's the most return on the time invested, or the most return on the money invested? And I felt, as much as I love the house flipping business, with my technology background, the highest leverage opportunity for me was building something that scaled up quickly without having to hire lots of employees, right? If you want to run a national house flipping operation, that is a logistical challenge, requires a lot of employees, a lot of capital, a lot of risk. Whereas selling leads to real estate investors all over the country, much less overhead, much less risk, and significantly less capital to make that happen, and scales up really well. So the business could double, triple, quadruple in size without having to hire a lot more employees, without having to get big office space, kind of do all these things, because it was technology-based rather than people-based.
Okay, so you made a decision, how can I scale rapidly instead of necessarily, hey, how can I build this huge monstrosity of a business that's going to be expensive, capital intensive, et cetera. So you could just cut it right there. Man, I've got this lead. I can go sell this lead to somebody and be much more profitable, like from day one, I would suspect, as you started to ramp that up.
That's right. Yeah, very profitable from day one. And we have in the lead generation business, kind of one of the tricks that I learned early on from other mentors was this idea of a cash conversion cycle, where in kind of traditional businesses, you pay a bunch of money to manufacture something. It has to be shipped to you. Now you've got this product, and then you sell it to somebody. And if you're in the business to business world, often they're on net 30 terms. So you've got months between when you paid to create something and when you get revenue for selling that thing. In our business, we created a negative cash conversion cycle. So we charge our customers up front a deposit to receive leads from us. So we've got the money up front. And then mostly we pay companies like Google and TV stations and direct mail houses to advertise for us, to produce those leads. Well, we pay them on credit cards and often have net 30 terms with them. And so we have this cash conversion cycle of, let's say 90 days, 60 to 90 days, where we're able to hold on to our customers' money for 90 days as we deliver the value that we promised to them before we pay our vendors. And so unlike a traditional manufacturing type of business or product business, when they scale up, they require massive amounts of capital. Right? Yeah. The faster they grow, the more they're out of money.
More capital. Yeah,
everybody from the outside looks in and says, you got this amazing business. Like, I got no money at all.
Right.
And I got to borrow left and right from the bank. Whereas this business, we were able to scale it up. And the faster we grow, the more money that we have from our customers on deposit. And it's allowed us to scale it up without having to raise any outside capital, without having to get investors, without having to get lines of credit. That's one of the things I love about some of these technology businesses, where you can kind of orient things in a certain way that allow you to do that type of scaling without having to go out and get investment money.
Yeah, that sounds really appealing. And that's similar to like our business. Our business is kind of similar from that standpoint. It's not very capital intensive. It is very hard to scale a little bit more difficult than probably technology, but very similar from a capital standpoint, which always appealed to me because the whole time I was trying to build my business, I was also trying to raise and pay for a family. You sometimes that intersection between the entrepreneur who wants to dream big and create this wonderful business over time conflicts with the need to have capital for your family and be able to continue to pay your own mortgage, right?
You can't live on ramen forever.
No, you can't at all. So that's very interesting, and I would think that being able to, I just kind of think of it as you're just kind of cutting short the cycle a little bit. When you sell that lead, that also allows you, because the real estate market is cyclical, wouldn't you say?
I've been through a few of them.
Yeah, it's very cyclical, and if you have product on the ground, in this like a house or whatever it may be, that cycle can actually occur while you have capital invested and hurt really bad. But from the technology standpoint, being able to cycle that quickly probably helps you survive those cycles a little bit better too, I would think.
A little bit better. I mean, we definitely had some struggles and learned a lot of lessons in the cycles that I'll talk about. But to your point about kind of where does most of the risk lie and how do you manage some of those cycles in 2008 when the housing market crashed, we had very large customers in our leads business, people making millions and millions of dollars a year, flipping houses. One client in Florida, and they had, I think, 22 houses in process as the market started to tank. And, the market turned. They had 22 houses in process, most of them with hard money loans on them. And the houses were underwater. They couldn't sell them. They had high interest rate loans. And, after a period of 10 years of amazing success, they had to declare bankruptcy.
Oh, they were done.
Because there was no possible way for them to get outside of that scenario. They couldn't sustain it. So that happened to a lot of our clients during that period of time. And it was really, probably one of the toughest parts of my career was kind of going through that cycle. And I learned a lot of lessons in it that I still apply in our business today. One of the things I really learned, and we lost money for 2 or 3 years during that cycle. So even though having a technology-based company makes us very nimble, it's still easy to get caught.
It's still hard.
It's still easy to get caught, and I think with the lesson of hindsight and experience, it's very easy to not cut things quick enough. I think entrepreneurs, by definition, are very optimistic, and they really just feel success is right around the corner. The next thing's right around the corner.
Mm-hmm.
It's a thing that can hurt us, but is also kind of a superpower that lets us push through difficult times and create these successful businesses. But when a downturn is happening, and I made this mistake in 2008 myself, not cutting things quick enough. When things are getting worse and getting worse and getting worse, I always kind of felt like, well, they're just about to turn around, as we lost money and lost money and lost money. And one day I remember, and I kind of stuck my head in the sand a little bit during that period of time. I remember one day just kind of waking up at 3:00 in the morning and saying, I think I'm out of money. This is
at 3 o'clock. That 3 o'clock conversation with yourself.
Wake up in a cold sweat, and so I remember getting up. I still have this note. It's like one of the things that I kind of hold on to. I still have this note where I sat down. I said, I have to get real honest about what's happening here, and I made a list of all of the assets I had, all of the liabilities they had, what our cash flow was, and really took a stark look at it, because I think it's easy to stick your head in the sand and just kind of keep pushing instead of really taking a step back and saying, let's be honest about the situation. And this was, 2008, 2009. And I realized that technically I was bankrupt. I had money in the bank, but my liabilities outstripped my assets. And if everything were to be shut down, liquidated right then, I would owe people money. I had more liabilities than assets. And it was a wake-up call. And what came out of that was I said, well, if I'm bankrupt anyway, then now it gives me the freedom to make any decision in the business that I have to, because it's all going to go away anyway. And up to that point, I had been kind of lying to myself about, well, it's just going to turn around, and this is my baby. It was the first real business I had, and I was so kind of wrapped up in it that I couldn't make some of the tough decisions that had to be made. And that week, so I woke up in the middle of the night, kind of wrote this note to myself, and went through the numbers, and kind of gave myself a pep talk about if it's all going to go away, what are you going to do? And then within a week, I had let go of all of our office space. I had laid off every single employee. I went back down to me working out of the back bedroom of my house and said, if it's all going to disappear, I might as well manage that correctly and get through it and cut all the expenses. And had about 2 to 3 years, we lost money every single year, but less money each year. And fortunately, I had built up a bit of a war chest so that we could lose money every year and not be completely out of business. And was able to manage through it. One of the toughest kind of periods of my life as an entrepreneur. But coming out the other side, all of our competitors had gone out of business. They had just shut up the doors and gone to do something easier, which is often happens in real estate. It's very opportunistic, right? When times are good, everybody jumps in. When times are bad, they'll go do something else. And so we had survived through that. And as the market came back, we were the only marketing company still doing this for house flippers.
Because they had gone completely out.
Everybody else had left, right?
They're just done. They're out. Okay.
They had gone and done easier things, and I had kind of stuck with it. And so as the market came back, we were the only people providing that service. And so we got all the market share as the investors started to come back into the market and were looking for ways to find properties. And so we had a really great run of 3, 4, 5 years of growth before all the opportunists kind of started coming back in and copying our business model and looking at what we were doing and knocking it off. And but so it was an example of kind of in my mind, I don't know if it was smart or not, sticking through the really tough times and pushing through the other end. And out of that, my kind of lessons learned have been dealing with the tough things much quicker. It is so easy for us to not fire an employee when we know that we should, not downsize office space we know we should, not fire a customer we know we should. And we're eventually going to get there 6 months from now. So why not do it tomorrow? Like if you know you're going to do it 6 months from now and you're just kind of avoiding the tough thing, just do it and move on. And that's one of the things that's tough to do, but that I kind of learned out of that period of time. And then the other big takeaway for me was, especially as an entrepreneur, you have to have 6 months to a year of runway. You can't do it at the very beginning, but once your business is really rolling, having cash in the bank or in some investment that's easily accessible, so that you're not bankrupt personally or bankrupt in your business if you've got 3 bad months or 6 bad months. You kind of have to have something set aside for the tough times so that when they come, and being in real estate, I've been through 2 or 3 of those cycles. I know they're coming. You've got something set aside to weather the storm, because I also know the real estate's always coming back. It's just how long can you ride it out, right? So do you get wiped out or do you ride it out? And so we always keep some reserves so that we're not going to get wiped out in the lean times. We're going to ride it out and then be ready to take off in the good times.
Oh, that's excellent. So that balance sheet exercise that you did at 3:00 in the morning, see, that intrigues me to a great deal, because I think there's a shift that does have to happen with entrepreneurs. Cash flow is so critical starting out. Well, it always is, but starting out, cash flow is so important that sometimes that we ignore that balance sheet exercise, which becomes in some ways even more important, because the whole idea is to be able to build wealth, right? And
Absolutely.
that's assets minus liabilities keeps becoming a larger and larger positive number, right? And recognizing where you are is so important to be able to recognize what you need to do to get to where you want to be. And then the other, I've thought of so many different examples of businesses that I've known, trying to weather through storms. Like obviously for us, 2008 is a classic example for our generation.
You get a lot of bad calls that year.
Yeah, absolutely. But there've been others, and anyway, going through those cycles, you do have decisions that you have to make, and they're very important decisions. And yours was almost like, and correct me if you think of it differently, yours was almost like having a foot in both places, because you did your balance sheet exercise, you took it all the way down, just stripped it all the way down to what you needed to survive, but yet at the same time, you kept your foot in the door, and kept your business going, so that when it did turn, you were there and it was just blue skies, nobody else there, instead of just shutting down completely and having to ramp back up again. It seems to me that you almost kind of did both at the same time, which I I think some of the mortgage industry right now is, I mean, just got devastated. And I think it'll be interesting to see and watch as that as that industry recovers a little bit, to see who survives. And I think it's going to be the ones that did it the way you did.
Mhm.
Where they really got smart about getting their expenses down, but at the same time they kept some kind of machine going so that when it
Right.
does turn, they're right there.
I was having a conversation with a friend of mine just 2 days ago about this. He does some consulting and his large mortgage companies as his clients, and he was
Yeah.
saying, it's and we're mortgage companies follow the real estate cycle, so they're also in the kind of
But this one
second
was
or third
so bad for them.
real estate cycle that I've seen them go through. And he said, yeah, some of our clients, they as soon as the interest rates really started shifting, they knew exactly what was going to happen. They had been here before. They cut 80% of their workforce.
Yeah.
I mean, it was just the next day, the office is empty, severance packages, the whole thing. But we realized that this cause has this effect, and we know exactly what's going to happen to refinancing. And because we've had this massive refinance boom off of incredibly low interest rates, nobody's refinancing now.
Right.
And I think the really smart CEOs had to make those tough calls and say, we just have to lay everybody off. We're not shutting the doors. There's still going to be some activity, but there's going to be 70% less activity for the next year or two, or however long it takes.
Yeah.
And they go through those cycles. And then as soon as it ramps back up, they can hire everybody back, many of the same employees. They just can't afford to keep them on payroll through that lean time.
Yeah. No question. Well, let's shift a little bit, because we talked about kind of how you got started in this really smart move of, basically selling those leads so that you didn't have weren't completely exposed. For instance, in 2007, 2008. But now you've shifted and you've become an investor in real estate. I think you always have to a certain degree, but an investor in real estate, but not necessarily from an equity standpoint, from a debt standpoint. Is that correct?
That's right.
Yeah. So talk to us a little bit about that and how that came about, where you started lending to some of the house flippers in the real estate market.
Yeah. Well, I mean, that's been, my whole world for the last 23 years or so.
Yeah.
And so, have a lot of awareness in the community, a lot of really great relationships with people kind of in the real estate community. And, as my business is more successful, what every entrepreneur does is say, we're starting to build a little bit of wealth here. Where are we going to put it? We're going to put it in the stock market. We're going to invest in, when I was in my 20s, I made some really terrible oil well investments. I didn't know what I was doing, and got caught by a couple of those guys. And so, I really looked around, and as the interest rates started to rise, and banks, even more so, banks started to pull back from lending almost at all. I started to get contacted by more and more people that were looking for loans on real estate, loans on flipping houses. And in my, analysis, it was one of the most secure, highest return ways to deploy capital.
Yep.
And so I think a lot about kind of risk versus reward, right? The more risk you're going to take, the more reward you want. And when you can find a pretty safe return and a high rate of return, that's a gem. And it seems like that kind of this hard money lending, asset-based financing, where you've got a physical asset that you're lending against, hopefully at a discount from what its true value is. You are very secured in that position, because if the borrower isn't able to pay or something happens, you can take the asset back and then sell it and break even on or make a little bit of money on the loan that you made. And so that's what I've been doing for maybe 5 years. It's not a kind of a primary business for us, but it's a great business. And we've done home builds, a lot of house flips, some commercial real estate development, and it's gotten incredibly busy now because we've seen the banks have just completely pulled back from real estate financing.
Yeah.
Mostly, it seems, I've talked to a couple of bank presidents over the last 6 months, and it seems mostly because all the deposits have left the banks, and banks by regulation can only provide loans relative to the amount of deposits that they have in the bank. And so you had all these people that, because interest rates got really high, they can put their money in CDs or different financial instruments that aren't a checking account and get a really high rate of return with almost 100% security. and they don't have money just sitting in their deposit accounts. And then you had the failure of a couple of these banks that made people really worried about keeping high balances. And so those that weren't in CDs moved all their money over to the big three or four banks, too big to fail banks. And so these regional banks that have classically always been the people lending on real estate, supporting entrepreneurs, supporting real estate development, just couldn't lend money. They didn't have the deposits to do it. And their boards didn't want to expose themselves to a lot of risk as the real estate market was kind of going through the cycle that it's in. So that opened up the opportunity for a lot of very secure, very low risk investments or loans on real estate developments, houses, home builds, that type of a thing. And because I know that market really well, local here in Texas, I know lots of people in the space. If we ever did have to take something back, it's very easy to quickly dispose of it.
Yeah, so you're just staying within Texas, where the bankruptcy laws and all the rules and regulations.
That's
Again, recognizing the fact that if you step outside into areas that other states, for instance, that brings additional risk.
That's right, and we have limited capital, the other thing that I learned kind of in my entrepreneur career is staying focused is so much better than trying to go broad. And it's the temptation of every entrepreneur, especially early on, to do everything for everybody. You'll take every customer. Anybody wants to give you $1, you'll take. Every good idea is a good idea. And I still suffer from that a little bit, but especially suffered from it early on in my career. And as I've kind of gotten older and more time has passed, I've really learned to say no to a lot of amazing opportunities, a lot of things that are nothing wrong with them, great opportunities. But I only have the capacity to do so many things at a time. And it's much better and much better use of my time to focus on, 2 or 3 really important high value things that I can be laser focused on, than kind of pinging all over the map with every great idea that comes along. And they're great ideas and they could also make a lot of money. But I think you create more wealth by focusing on 1 or 2 things than you focusing on every great opportunity that comes along.
Yeah, no question. Yeah, I agree with you. The way you were talking about risk and reward, makes tons of sense. As an investor, and it is an interesting time. I agree. It seems like the banks are definitely out on this stuff, and there are. You described it really well. I would say, additionally, what was weird prior to this current environment that we're in, the banks didn't even care about deposits at all.
Right.
Because they could borrow money practically for free from the Fed.
Mm-hmm.
And obviously a part of this interest rate environment that we're in or all of it is Fed based, right? So the banks can't necessarily borrow for free per se. And now they have this great pressure to have deposits on hand. And it's the weirdest thing ever. I mean, forever, the banks never cared about deposits at all. Now that's all they want.
They're begging for deposits.
They're just begging for it. Yeah. And we actually have our clients in a lot of opportunities like what you described, on the credit side, because of what you look at. You have to look at your return and you have to look at your risk, right? And they're always related. There's no question about that. But sometimes some of this credit stuff steps up into market level return areas, and then you protect yourself, like you said, by having really strong collateral. For those of y'all not familiar, that's what hard money means. It means, I'm going to lend you the money, but I'm going to take, an asset equal to or greater than that loan, if you default on it.
That's right. It's
kind of what hard money is. So you're protecting yourself to a great deal, recognizing the fact that, in certain circumstances, maybe even a quarter of the time, you're going to have to step in and, take that collateral, and you have to be ready to do that. And you've got to, how to do that.
Yeah. And, we never want to do that.
No,
when I'm talking to people, I never want to put, I vet people that we lend money to pretty well. I never want to lend money to somebody that has any chance that this might not work out. Right. And that's, that's important to me.
Yeah.
And so certainly you've got that asset and you want to have the asset there for your protection. But I've, fortunately, to date have not had to take back any asset.
Oh,
We've
that's
definitely
good.
had to work out some deals, and we've had people that weren't able to pay their loan back on time, but we haven't had to take anything back yet. And I think that's that's important to try to, because I'm an entrepreneur and I'm lending to entrepreneurs, to figure out how to work through tough situations and find creative solutions to those tough situations, rather than just take the asset back and move on. I have a little bit more kind of care about making sure that people are able to work through those things. And so it's not often that we'll lend to somebody that's their first or second or third house flip. They're kind of learning, that kind of a thing. I don't want to be that type of a lender.
Yeah, I understand. At the same time, though, it's a very cyclical industry, and if things turn, those loans could potentially go, and that's how it works in a cyclical, and everybody understands that.
Mm-hmm.
Okay, so that's very interesting the way you've transitioned, and still yet I see you being somewhat, I wouldn't say risk averse, but risk smart in some of these decisions that you make, that I applaud you with, because a lot of times we don't see that with entrepreneurs. They'll just, like you said, chase all those bright shiny things and just go and not even think about the risk. But you've done just a really good job of developing all your businesses in a way that you're looking and going, yeah, no, I don't think I'm going to do that because I don't totally understand it, or it's way off over here, or it's just not what I do, right? And just making those hard decisions is fantastic. With WeBuyHouses.com, when you came in, I kind of thought that was a franchise setup, but it's not. You do like licensing agreements on that, because that's not all you. You have different entrepreneurs out there. I don't know how many you can tell us, that have that name and that website, that URL, et cetera, that you provide this to. Tell us a little bit how you structured that and how that's working.
Yeah. So it was really intentional that I decided to not do a franchise and do what's called a brand license instead. When I first came up with the kind of idea of what I wanted to do, I spoke with a number of people that were franchisors. Brian Scudamore, who founded 1-800-GOT-JUNK, had a conversation with him, and other people that ran big franchises, and also franchisees of what they loved and didn't love about what they were doing. And the way that I came to the brand licensing idea was, franchising is fantastic for people that have never done the thing that they're buying a franchise for, and they want to follow exactly the formula and process of the franchisor, right? You don't want to go to McDonald's and have a burger that tastes different than the other McDonald's. The formula has to stay the same. The process has to stay exactly the same so that it's consistent across the entire system. And so there are franchises out there, and they're great at training people how to be real estate investors and kind of giving them the tools, and then saying you have to operate exactly within our framework, and we're going to take a percentage of everything off the top, like a franchise does, to support itself. And that's all great. What we had seen over the years with our people that were buying leads from us was that when somebody was a very experienced real estate investor, they became incredibly frustrated with the franchise system. Frustrated because it has high overhead. Frustrated because they were very restricted in what they can do. And so there were very tight rules around how they could do things, the way they could do things. And then very frustrated with how territories were assigned, where you put too many real estate investors in the same market under the same brand, and now they're fighting with each other, and kind of saturate the market under that particular brand. And so when I acquired WeBuyHouses.com, my idea was to solve for that. And so the value of the brand licensing in my mind was, we give people exclusive territories. So if you're in Atlanta, Georgia, you're the only real estate investor in Atlanta, Georgia under our brand. Now, it limits some of the ways that we can grow, but it provides a huge amount of value to our local real estate investor in that market, because now they own that market. They can do as much advertising as they want and know that they get all the benefit from that advertising rather than sharing it with other people. We also focus a lot on making sure that we get really experienced people in the system. We don't have any novice investors in WeBuyHouses.com. Almost everybody's been doing this for 10, 15 years. They're buying dozens to hundreds of houses a year. They're running real businesses, real multi-million-dollar businesses. And they don't need us to train them how to do anything. They already know what they're doing. But what they would get from a national franchise is the power of a national brand, the power of building national marketing campaigns, TV commercials, all these different kinds of things that comes from a national brand. And we can give that to them so that they can operate as WeBuyHouses.com in their local market, but still do business the way they want to do it business. If they're doing Airbnbs, great. If they're doing long-term rentals, wonderful. If they're doing flips, fantastic. We don't tell them how to do business other than honest, ethical, follow all the laws, treat people right, all that kind of stuff.
Yeah.
That's an important requirement. But beyond that, there's a lot of different ways to invest in real estate, as you know. And we wanted to give people those tools. And so it's been very rewarding to see how that's built over the years. We have about 100 or so offices around the country.
Okay.
Most major cities in the United States have an office in them. And they're doing all different kinds of things. Like I said, some people have huge rental portfolios. Some people just want to buy, fix up, and sell houses. And we've got our annual conference coming up later this year, where everybody comes to Dallas and we get together for kind of a mastermind conference.
Oh man, I bet that's huge.
Well, one of the amazing things about it that we found is because we had exclusive territories for everybody, everybody that shows up to our conference is not a competitor.
Yeah,
they're all in the same business,
exactly. That's what I
but they
think.
don't compete.
And they're all doing it differently too, which, that's what happens when we have conferences with, NAPFA, for instance, is our fee-only financial advisors, which are a very small portion of the financial services. We're not competitors.
That's right.
And you get to share. That's got to be a great conference.
Well, and that's why I love mastermind groups, because you just get a bunch of smart people in a room that have all figured out different ways of doing something similar and just facilitate conversations. There's going to be so much wisdom that comes out of that room that I don't need to be up there training people or talking about things. We just need to create the environment where all these people that are in the trenches and doing really well can share with each other. And we've had many amazing stories come out of our conferences of people that have scaled up their wealth considerably from small things that they learned from somebody else at a conference. And it was a light bulb moment for them, and they kind of changed the trajectory of their business. So that's one of the funnest things that we do, and that is the annual conference and get everybody together.
Yeah. Yeah. And then so this license agreement just is, you charge them something on an annual basis, I would suspect.
That's right. It's fee-based rather than success-based. So we don't, we said we don't penalize you for success. We're not charging you more the better you do.
Okay.
We charge an upfront fee and a flat monthly fee, and then various additional services if you want us to do particular things for you, execute marketing campaigns, that kind of a thing.
Okay.
But it's very simple and very clear, and they don't feel like the better they do, the more expensive it is. We really want to make it a partnership. Oftentimes, the franchisor-franchisee relationship becomes a little antagonistic, and we wanted to kind of not let that happen. We wanted to figure out how do we get us all on the same page so that we're kind of fighting the battle together rather than adversarial a little bit.
Yeah, I like it. Very good. Well, Jeremy, I would be remiss if bringing an absolute expert in the residential real estate market if we didn't talk about the real estate market a little bit and where we are right now. Yeah. We talked a little bit about the banking market, which is just in a really weird place. Mm-hmm. But man, residential real estate is in a really weird place too. Talk to us about it. Tell us kind of where we are and how we got here and kind of what you're seeing.
Yeah, I mean, my perspective comes from the distressed property side of things, so maybe it's a little bit different than kind of the broad view of real estate. I mean, I think it is, as far as real estate investors are concerned, they have residential investors. They've pulled back a fair amount, not because there's any fewer houses available for them to buy. So we still have the kind of deal flow of home sellers that have houses in need of significant repair, and the seller needs to move. Where I think a lot of investors are concerned, and this was similar in 2008, is how long is it going to take me to sell this house, and at what value can I sell the house for? So I can buy a house and I can fix it up and I can put it on the market. What's that cycle going to be? And I think we're doing this podcast from Dallas. I think Dallas is a very unique market and very insulated from what's happening a lot of the rest of the country.
Yeah.
We have massive amounts of people moving into the North Texas area. We have lots of large companies moving their headquarters here. We have an influx of people. And whenever you have that, it makes real estate move quicker. So in the residential market in the DFW area, while slowed down certainly by high interest rates and people in low interest rate loans that don't want to leave their house because they're going to lose that low interest rate loan if they sell their house, that's slowing things down a bit. We've got net growth of population, and so that juices the real estate market. So it's a pretty good market in DFW for the residential real estate side generally. But across the rest of the country, We definitely see these pockets where during the good times, there's big run-ups in value. When the tough times hit, the value goes down just as quick.
And that has happened in most of the country. I would
Absolutely.
suspect.
You look at, Southern California, Phoenix, Southern Florida, around New York. There's a lot of these areas that have run-ups in prices, and then they go right back down when the market slows down. Now, over the course of a 7-year cycle, it's a nice slow curve. But if you zoom in, it kind of spikes up and then drops down. It spikes up and drops down. It's pretty consistent. We saw the same thing in 08 and in different cycles in these hot markets where they pop,
Sure.
home values double in 2 years, and then they drop back down really fast. And so if you get caught in that cycle, if you bought a house at the top, it's going to take you a while for the value to come back. But if you're kind of a longer term holder, it's not too bad. So yeah, I think the rest of the country, we got to struggle with housing, and I think until interest rates really start to come down a bit, we're going to continue to have that. It seems to me like what I've noticed is it takes people about 2 years, takes homeowners about 2 years to accept whatever's happening in the market. And what I mean by that is even in 08, you had people, let's say they had a house that was, they bought for $300,000 and it had gone up to $350,000. And then the real estate market cools and the house is now, back down to 300 or maybe 290. Home sellers tend to not accept, until they actually sell the house is worth whatever they think it's worth in their head.
Yeah.
And home sellers just tend to not accept what the market value of anything is because they don't have to accept it until they're forced to sell their house. And so you have a lot of people that will put houses out there for inflated values relative to what the market will bear, and it won't sell, and they'll take it off the market. And so we're seeing a lot of that happen. And I think we're kind of coming up more on that 1 to 2 year cycle where people just accept the environment. They accept interest rates are higher, and that's
interest rate.
That's it. It is what it is, right? You're not going to change it.
Yeah.
So you got to accept that that's where interest rates are. You can hope they're going to go down, and I think that they will over the next year, but we're not going back to 2 years ago.
No.
Probably anytime soon or maybe ever. And so, but it just takes people a little while to get used to, well, that was the good times, and now I just got to accept, what today is, and this is the new normal.
Yeah.
And it takes people a while to just internalize that, we've found. Because we get a lot of people that contact us to sell their house to an investor, and they just have a completely unrealistic expectation of what their house is worth. They're contacting us because they didn't want to sell it with a real estate agent because the agent gave them a price they didn't like, and they were going to have to pay 6%. Like, the investor's not going to give you, more money than a real estate agent's going to list your house and sell it for and pay you cash and close in a week and.
Right. Yeah. What about, so another question, because you said that some of the folks that you work with do Airbnb type work and that sort of thing. Yeah. As a financial planner, it's been interesting to me, during the pandemic, we obviously had a lot of clients that went all in, on Airbnb type properties and stuff. And talking to them now, that has slowed significantly, at least in our little slice of what we see. Mm-hmm. What do you see going on in the Airbnb type market?
I think Airbnb or short-term rental.
Yeah, short-term rental. Yeah,
short-term rental I think is still a great market. I think it is more and more focused on vacation-style properties than kind of regular neighborhood type of properties for a couple of different reasons. The vacation style properties are easier to rent out or on a short-term rental. People are with families that are traveling for vacation, on a lake next to a park, something like that.
Yeah, so those types of properties are worth, definitely having. It's definitely slowed from what it was before as far as their occupancy and so forth.
For sure. I think there's a couple of things that are impacting that. One, it's more difficult to do short-term rental now because a lot of cities all over the country have gotten aggressive about trying to ban them.
Sure.
So you've got neighborhoods and hotel groups that are trying to block short-term rentals. And so I think that makes it kind of difficult to do. And then I think you also have a saturation, right? So there's only so much, it's like having too many hotels in a city, right? There's only so many people that are visiting or need temporary housing in any particular city at any particular time. And short-term rentals were so popular for a while that I think in some areas they've become somewhat saturated. And so there's just too many available. And what happens? Either the price goes down that you are able to charge for that short-term rental, or your occupancy just goes way down. And I think that is happening in a lot of markets where people just had a lot of these long-term rental properties. And as somebody left, they cycled it into a short-term rental because you could make a lot more money on a short-term rental than long-term in most parts of the country. But that also means now we've got a glut of that kind of inventory. And so people are probably going to cycle back to some of the longer-term rentals.
Yeah. And would you say, I mean, we certainly had a lot of people enter into the short-term rental space as new investors, for instance, as well. And that may settle out. We may see a little bit more of, the type of people you work with are a little bit more seasoned, a little bit more long-term, using it as their primary business than being kind of a side hustle. Do you see that as well?
I think so. I mean, I think you probably always have people that are, have regular jobs, W-2 employees that have, the last house they lived in, they Airbnb'd it, or they bought an investment property. I think that's all great. I divested myself of all my long-term rental properties a while back. And when people want to get into this property renting, I always tell them it's really tough to have 1 to 4 or 5 rentals. Yeah. After that, it gets really good.
Sure.
But at 1 to 4 or 5 rentals, you're doing all the work. You're
doing as much work as you would for 20.
You're not making enough money off of the rentals to pay somebody to do all the management for you. And it's easy to get caught up in a maintenance issue that wipes out your profit for the entire year if you've only got a couple of properties.
The risk, diversification.
As you get bigger, that diversification makes it much, much easier to pay somebody full-time to manage it, and also to spread the costs across all of the units, have a handyman that can go out and fix anything whenever you need it. So, I love real estate as a long-term wealth building strategy and long-term, cash flow strategy. I think sometimes people go into it thinking it's going to be passive income, and an Airbnb is absolutely not passive income for most people. Yeah.
Very good. Well, excellent. Jeremy, this has been a great talk today. I appreciate you coming in and sharing with us and talking us through all the exciting stuff that you have going on. Congratulations on all your success. Where do you go from here? Kind of, what have you got going forward at this point? Obviously you've had a ton of success with everything that you've kind of touched through here. Where are you going next?
Well, I love starting and building businesses. And so we're going to continue with the ones we have. I probably will start something else in the next couple of years just because I can't help myself. I tend to kind of get things from an operational standpoint where they run really well, and then go focus on something else. And then, I love to give back. So we had talked a little bit earlier, the way that we met was through Entrepreneurs Organization. I do a lot of mentoring through EO, Entrepreneurs Organization, helping earlier stage entrepreneurs not make a bunch of the same mistakes that I did. And so I enjoy doing that. I enjoy talking at schools and being on podcasts, just kind of sharing some of the things I've learned and mostly the mistakes that I've made over the years to try to help other people avoid those same things. And then, I do some investing in startups and advising to startups as well.
Great. Well, Jeremy, if somebody wants to get in contact with you and discuss some things further along any of those lines, I hope that's okay. And is there a way to contact you that we can put in the show notes?
You can always reach me on X at Jeremy Brandt, my name, or you can go to jeremybrandt.com, and I'm happy to reply there.
Okay. We'll put that in the show notes as well. I encourage you all out there, if you have questions for Jeremy around real estate investing, entrepreneurship, and those sorts of things, reach out. Great guy, great resource. Again, appreciate having you on today. I want to remind everybody we put one of these out every other week, and it's all designed for you, for the closely held business owner as you try to grow and succeed. Hope everybody has a great week. Take care.